Hi, so my name is Brad Laddusaw, president of the California Mortgage Association, and I'm very happy to have Mr. Nema Daghbandan with Fortra Law and Lightning Docs joining me today. We were talking briefly here before we jumped on, and I told you this is going to be completely unscripted. So for all of you that are just curious, here are all the questions that I gave Nema ahead of time for this podcast. So we're just gonna roll with it.
The joke's on you. I came with a whole list.
Well, I've been lucky. I mean, Nema, I think we originally met. It was probably 2013. So I've known you a long time. So I'm excited just to have a conversation. And we were talking beforehand. I cannot call this thing a podcast. I will not call this a podcast. This is not a podcast. We just can't interview each other in person, and technology allows us to do this. So with that being said, would you mind introducing yourself, Fortra Law and Lightning Docs briefly, and then we'll jump right on into it.
No, I appreciate that, Brad. And thanks for having me on here today on your podcast. It's
Don't say it.
It's a great podcast, and I've heard that this podcast is going viral nationally throughout the country because, that's what podcasts do. So I appreciate you having me on today. But my name is Nema Daghbandan. I'm one of the partners with Fortra Law. I have many other partners at the law firm itself. And Fortra Law, for those that don't know, it's the nation's largest private lending law firm. And what I mean by that is it's a law firm specialized in the representation of private lenders nationally. There's about 100 of us total here at the team. And we represent clients for all of their private lender needs. So it's kind of a function or a purposely built law firm that is designed to be kind of cradle to grave for services that a private lender would want to have. So what that means is that we've got a corporate and securities practice. They do fund formation. They do licensing. They do kind of the early capital raise side of this business and I call it the dreamer side of the business, right? So I've got a dream and I want to do something with a business and I want to grow a business. And so you're over there talking to my partner, Kevin, typically, and my partner, Jen, and they run that side of the business. We have our loan document and our banking and finance team. So that's where really the operations side of our business comes out. So great, you've raised some money, you've got a mortgage fund, or you've got the capital side locked down, and now you need to go out there and make some loans, right? So you want to make some loans in California or Florida or wherever it might be, and you want to make sure that you write that from a compliant fashion. So do you know if there's prepayment penalty restrictions because you're making your first loan in New Jersey? Do you know what the late charge restrictions, because you're doing this in Texas? Can you make a business purpose owner occupied loan because you're in Florida, right, et cetera? So kind of thinking about the framework of all the loans. And then we've also got a loss mitigation team, or we call them our litigation practice here. And they're the ones that, it's a numbers game for anybody that's been in the lending business. When you put your money out there, the goal is to have it paid back. But sometimes that doesn't happen or does not happen in an expeditious manner. And so we send the big guns, as Steve Ernest, my partner there.
And he's literally tall, so he's a big dude.
He's a large man. Yeah. Large man. And so, and Steve does not mess around, as you also know. So Steve is the one that gets the money back in the door and makes people act right. So that's Fortra in a nutshell, but kind of cradle to grave if you're a private lender anywhere in the country. And then separately is we have Lightning Docs. Lightning Docs is a software platform that writes business purpose mortgage loan documentation anywhere in the country. It's the largest platform of its kind. More than half of the top 50 national private lenders in the country now use it. Generates a little more than 5,000 sets of loan documents every month, almost $3 billion of monthly loan document transactions, both for your kind of typical short-term, what you call them, bridge loans, hard money loans, RTLs, whatever you want to call it.
Oh, you've heard my spiel. Whatever you want to call it on a Friday, baby.
Whatever you want to call it, right? Like those loans. And then it also does the 30-year DSCR loans. And that's what it does. And that's all it does. But it does it really, really good. And people like it. So.
Well, thanks for the extended breakdown there. And I mean, in the private lending space, I mean, we are so hyper focused and nuanced in the types of deals that we can do. And there's, licensing issues from state to state. I mean, California is one of the toughest ones. What would you see what is one of the easiest states to get up and running in
Yeah,
for a private
I
lender.
mean, that's the beautiful thing about the nature of this world is it's actually pretty easy to do this most other places in the country. So, it's somewhere around 39, 40 states that simply look at this and go, well, what's the nature of this loan? Is it a business purpose loan? Great. If it's a business purpose loan, even if it's secured by a single family home, you don't need to be licensed as a broker to broker that loan. You don't need to be licensed as a mortgage lender to make the loan. You don't need to have an NMLS or an MLO attached to it. And similarly, as you likely don't need to be licensed as a mortgage loan servicer. So most of the country says, you know what, when you're making loans, and they think about this as kind of the traditional business to business lending, right? And most of the state says, great, we want you to make loans to business operators in our state. We want you to bring capital to our state. And so that's why you have a really friendly, typically regulatory climate, at least as it pertains to licensing most of the country. The big exception, you and I live in this great state of California, it's not that way. California says, hey, actually, not only do we have one regulator, we got two regulators you need to worry about here in California to make a business purpose loan, right? But we're not the only ones. You've got Oregon, Washington, Nevada. Most of the states around us think like us, right? They have typically, the most restrictive parts of the country are right around us.
And it's when you get into that, I mean, it's a double-edged sword in the state of California. Me, I'm of the belief, yeah, I want you to get licensed. I want it to be a challenge, have a little bit higher barriers to entry, but more so, not necessarily because I want to be over-regulated, but I think in itself, it can help borrowers and investors kind of vet who they're working with. Because for better or worse, everything is publicly available in the state of California when it pertains
Yeah.
to a license. And I don't think a lot of borrowers or investors realize that. I mean, Nema, you could verify myself, my company, and see what shit I've gotten into in the last few years if it was bad by
Yeah.
a quick search from each governing body. So would you mind breaking down the two licenses in California and their names?
Yeah.
I know one of them is extremely long,
You know,
and
and I think you made a good point, right? Which is licensing inherently bad? And it's interesting, right? I think that it depends on what the goal of the state is, right? So I think for a lot of states, it says, look, more liquidity, less barriers to entry is good for people trying to borrow money to purchase real estate investment, right? I think that's if I want to go buy a rental property, I want to fix and flip a property, et cetera. It's good because you're going to help provide liquidity in an environment that may not have it. You may have a local bank or et cetera, where it's hard to get financing. And so more people willing to bring in more dollars in there. And it's interesting, right? California is a really regulated state, right? As we just talked about, and I'll give you a second kind of the regulatory regime here. But it's interesting. You take a look at the state of California. I'm just looking at it from the purview of Lightning Docs.
yeah,
Lightning Docs has by far the most people who are making loans are still making them in the state of California. Even though that you have to be licensed to be in the state, even though it's regulated, even though there's a lot of reporting requirements, even though it's a difficult state, because it's also a great opportunity state. You have big loan balances, right? Your average loan balance exceeds $1 million in Los Angeles County. In Orange County, it's going to head there pretty soon. In San Diego County, so it's where a lot of the bigger transactions are, and where the bigger transactions and there's also a lot of opportunity. There's just lots of property, meaning lots of transactions that need this sort of financing, right? So even though it could have slowed down competition, it really hasn't for our purposes, right? And you know that, or I think any person listening to this podcast is going to know that, which is that the California, particularly over the last 10 years, has become very competitive. What I don't like about California is that it is dual regulated. I think it's a really weird way to do it. There's probably another 5 other states in the country that do what we do. So if you go almost anywhere else in the country and you look at who regulates mortgage lending, right? There's a Department of Finance or some department that has that kind of name involved in it, right? And it's the people who are going to regulate your banks. There are the people often, sometimes they have an insurance company under them as well. That's usually a Department of Insurance issue. But effectively, you have this concept of, look, you are in the business of providing financing, and so therefore there is some sort of financial regulator that should sit over you. What's weird about California is you've got this Department of Real Estate, right? Which if you want to go and you want Brad suddenly says, you know what, I'm over the financing game. I'm just going to help Nema buy his next home. You're like, great. What license should I get? A real estate broker's license. Oh no, I already have that because that's what I needed to finance the property. What license do I need to get him to help buy himself? Oh, it's the exact same license, literal same license to do. I'm going to
Maybe just
climb.
set up a new entity. Maybe just do
Really,
that. Yeah.
it's crazy. It's great. And there's a few other states that do this, and it's maddening. And it's so hard when you're talking to anybody else outside of the state of California because we're living in the bubble, right? So people in California are like, oh yeah, you've got the DRE. When I explain to people outside of the state of California, which I oftentimes have to do, and they'll say, well, I'm not licensed, so what do I need to do there? And I'm like, well, there's a lot of things you could do. You could come and get licensed in the state. You could go get a California finance lender's license, the Department of Financial Protection and Innovation out here in California. You don't have to. You could go to meet my dear friend Brad. Brad has a real estate broker's license. He can arrange a loan to you. You don't ever have to be licensed, right? We have a wholesale mortgage lender exemption under that license. And they're like, what? What do you like? This makes no sense. Do I need a license or not? Right? Like this, it's really confusing for most people outside the state, which is good for the Brads of the world.
And it's even confusing for some newly licensed brokers to
Totally.
understand the nuances. And we just have private money basics, and thank you for flying up north for that. But there's a mortgage broker compliance manual that not a lot of lenders are even aware of. And
Totally.
to the DRE's credit, they try and get it out there. It may not be the most organized on the website, but they have checklists and they got compliance checklists you could run through. It is a very dry read, but it's there. But yeah, it's the confusion is there. And once you think you have it figured out, oh, I'm actually not doing that right. And it could just
So
be
here's a fun segue. I learned about this the other day. You know what you could do is you could import the DRE, I think it's the RE7, which is the compliance
yeah.
manual. You could import that into an AI tool and say, make this thing into a podcast. Because I know you like podcasts,
Oh my!
and you can have it so that it is a back and forth conversation that appears to be in podcast form, talking about all the compliance rules for Department of Real Estate Brokers.
Oh
So
my
there's
goodness!
your free tip for the day.
So I'm gonna have to go through and edit and bleep out every time you say podcast. So it's just gonna sound like curse words throughout this entire thing because I am so against the P word. It's and anyway. So back to the two licenses.
Yes.
In the past, actually, I want to go back in time, like '90s, early 2000s. Can you? Because and we're going to take this through how quickly the private lending industry has changed over the last 10 years. It's just been accelerated.
Yes.
Can you explain how it was when you first started practicing as an attorney in the state of California? What did private lending look like? What were most of the lending companies structured like, their source of capital, and talk about how far their reach was. Was it nationwide or local?
So when I was a young warthog, it was the year 2010. And as you know, the economy was booming. Things were going great. If you all remember that GFC that happened shortly before then. So it was an interesting time because there really wasn't a lot of capital available if you were really any real estate investor. Didn't even necessarily have to be a hard money loan or those sorts of things. It was just a time of really, really tightened liquidity everywhere. And so that provided a unique opportunity for private lenders to step in. And you'll kind of see this theme occur all throughout any sort of liquidity tightening cycles.
And we'll see it again.
We'll see it again, 100%. Yeah. It's interesting is whenever I talk to people, particularly at the institutional capital level, and they just kind of look at what we're doing here, and because they'll try to benchmark what we do compared to conventional mortgage banking. And I says, you're missing something. Is that system inherently is so rate based that it's going to have it's baked in the cake that there's going to be high times of stress and then times of boom. And I go, and we just don't have that in our space. We're going to have periods of, there's periods of expansion, those sorts of things, but there's always really a need, because where private lending becomes most important is when other people stop lending. That's really, and so there really isn't such a thing as a true down cycle or this end all, because there's always going to effectively be a need for private capital. But take you back to 2010, the landscape, at least in California, was predominantly real estate brokers who had high net worth investors, and they'd say, "It's great, Brad, you're looking you found a property," because back then there was lots of properties to be had, particularly at foreclosure auctions, right? So we were still unwinding the mess of the GFC. And so you had all these massive portfolios and you had lots of banks and other financial institutions who had foreclosed on properties and needed to offload them because they're not asset managers. They did not want these properties. They were in terrible states of disrepair. And so if you're a real estate investor, it would have been a great time to say is, look, I can buy this property at a really low basis. I can throw just some quick money into the property, small rehabs typically. So, you would throw in 30,000, 50,000, 70,000, but these smaller budgets.
Literally, lipstick on a pig is what it was called.
Yeah, rinse and repeat real fast, right? Buy the property at 200, throw this in there, sell it 350, rinse and repeat. Kind of just it was a lot of properties in Compton and downtown LA, a lot of areas, just kind of easy churn properties where it was great, right? You were truly actually revitalizing communities very quickly. It was actually a win-win kind of for everybody. And then you had a consortium of what I would call professionals who said, well, I want to actually create a mortgage company, right? And the way I'm going to create a mortgage company is I'm going to call Kevin and I'm going to go get a mortgage fund set up, and I'm going to raise as much, instead of going and putting each individual loan together and going to my group of high net worth investors and saying, Jim, do you want to be a $100,000 participant in this loan? And Bobby, do you want to be a $50,000 participant in this loan? Instead, what I'm going to do is I'm going to go to Jim and Bobby and I'm going to say, Jim and Bobby, invest in my fund. Let's raise as much money as we can together. And I'm going to diversify all of your investments because I'm going to lend out all that money across 50 different properties, right? So even if one property just, we end up with mold issues or it ends up being, toxic or whatever it might end up being, you'll never just have that total risk of loss on a single asset the way you would in that individual trust deed world. And instead, I'm going to diversify over mortgage funds. So you kind of have two competing models, but it was predominantly, at least for us as lawyers and practitioners, it was mostly the real estate broker side of it, right? And so, and then you had the mortgage fund guys were still there and they were starting to grow. And I remember it was a big deal because they first started getting lines of credit. Like that's how unsophisticated this industry was that it was a big deal. You're like, oh my gosh, this guy got he got a mortgage fund of $300-400 million, which is incredibly impressive. But it was like, wow, some bank gave this guy $100 million of leverage. Wow, right? Like it was mind bending that this could be even possible. Right. But that's all that existed. There was no such thing, at least back then, of a model of saying, you were only as good as your balance sheet. Yep. You made your loans and you put them on a balance sheet. You waited for that loan to pay off. You go out back into the market and go make your next loan.
And you truly own the risk on that underwrite.
100%. Yeah. And so, and that also was a very, looking back at that time, it was some of the most conservative. It's funny if you actually kind of take a look back, I would call that the most unprofessional time in the market I've seen, meaning that the people involved were not particularly sophisticated. I didn't see, that there was not a lot of Wall Street and Goldman and these sorts of people kind of showing up in terms of the operational level as mortgage operators is really who it was. And oftentimes real estate broker people kind of showing up. They're smart enough people. They knew real estate wasn't, but they weren't all finance people in the background.
Yeah.
But the way that they underwrite these loans was it was very conservative. It was typically 60-65% LTV type loans, right? With very, very clear, understandable exit strategies. And, and that wave rode itself for some time until about 2015.
Yeah. And it's, so I got into space 2013. So it was still the lipstick on a pig. And I remember going to first CMA conference. I didn't know anybody. I was like, walk in and I was kind of mind blown to those points you just made. I was like, why isn't anyone packaging these loans up and selling them off or securitizing them? And I was 25 at the time and youngest guy by far probably in the room. And I was like, someone's going to make a lot of money once they do that. And then it was, like you said, about 2015. I mean, you still had a lot of the family offices started coming in, and then you had the fintech companies started popping up. Then you had Wall Street, because prior to that in 2013, I'm 14. If we priced a loan at 12% in California, you could get 17% in North Carolina for a first position trust deed. You could get similar in Georgia at same LTV exposures, but it was very regionalized on the capital available. And I remember talking to like finance guys, people that I still knew at Ernst & Young, and they're like, so like, what do you guys peg to? It's like, it's literally supply and demand of free capital in that market. So
Yeah,
it's not benchmarked to anything. And it
that's right.
was that always fascinated me. And then you had Wall Street. I think they were trying to dip their toes in. And I think the issue that which they beautifully figured out, I would like to say, is we have the money. That's not an issue. We love the returns. We're not going to get any type of return like this in the marketplace right now, secured in first position with
That's
an
right.
asset. But how do we get all the money out as quickly as
That's
we
right.
need to
I
get
need
it out?
because
Would you mind sharing how
they're
they
not
kind
looking to
of did that? I
do.
think the correspondent program exploded that and solved that issue.
And you hit the nail on the head in terms of what was the challenge at the time, right? Which is that if you're an investment banker, you're not interested in $10 million transactions, right? It just it doesn't work for
or a
them.
$300,000 deal in Compton. It's like, nah,
Totally.
yeah.
And so what you need ultimately is you need the ability to deploy at least $250 million or so in one tranche, right? But that, if we just talked about the examples, the really successful mortgage companies that were in our space at the time, that might have been their entire balance sheet, right? And those are the most successful companies. So there really wasn't anybody at one time saying, here's a pool of $300 million worth of loans, go ahead and package them. And worse yet is, if you think about it, if you're also in the business of packaging securities, you don't really have a 1 year security. That's not how securities work. It's not how securitization work. It has to be kind of 3 to 5 years of duration from a securitization perspective. So you have this mismatch of, hey, we need this product to last for a little bit longer, right? And we also need to be able to buy it in significant chunks, right? So that was the need from a Wall Street perspective. And the way that they got there was that you had this introduction of what we would call an aggregator, right? So, hey, can I instead if we can get these loan buyers that will come in and buy from Brad and then buy from this other person and buy from this other person, can they start packaging up pools of 50 to $100 million together? Right? Can they have some kind of short-term financing facility themselves to be able to start purchasing it, so that when the securitization party is ready to go and they need that $300 million filled, great, we've got 4 different aggregators pulling together. Here's your $300 million. Go ahead and package it. And then the separate thing that they did was they made it a revolving facility, right? So as the loans were paying off, they could just throw new loans into the mix, right? And so it gave an ability to provide constant liquidity and availability, and that completely reshaped private lending from that point forward.
And it happened so fast.
So
And it was, I remember talking to our investors, the risk return profile gets skewed quickly. I think versus your traditional, how it was, the most unprofessional conservative underwriting
that's right.
parameters based on leverage, I will say,
Sure.
back in the 2013 to now, where it's buttoned up. And you look at the leverage. If you talk to a private lender that is no longer lending, they did their last loan in 2012, and you told them what loans are being priced at right now in California and at what leverage, they would be, what? Like, but it's a different type of money. And I think that's where people need to understand that these effectively are packaged up as bonds. That's how they're
That's right.
priced, and they have certain duration. They have different. I would assume, I am not a Wall Street guy, but different, almost like tranches of risk level that
That's
you
exactly
have,
what it is.
and that's how it works. To where it's a one loan that you think is over the moon. I don't know why they would ever do something like that. It's like, well, that is just that is just an allocation of the overall to where it's calculated out. I will say that when markets shift, they do shift quickly. And the loan aggregators that you touched on, a lot of them got squeezed out in 2022. Because would you mind sharing what happened in 2022 and kind of how that happened? Because
Yeah,
it was, and it happened, I think, within like 30 days, 45 days.
totally.
Um, but
So if you think about the way that any bond, and so you hit the nail on the head, right? Which is that effectively what happened is this is a bond securitization like any other. And if you think of it from that framework, this starts to make a lot more sense, meaning that there's an acceptance of greater risk. So what are the other bond securitizations? You could buy a pool of auto loans. You could buy a pool of credit card debt. There's all these other things that are loan based, right? And so, but look at what we're offering, right? As you just said, it's a first position secured loan. So even if it's at very high leverage from their perspective, well, would you rather have that? Or would you rather have the auto loan in which the car that's secured by that, the moment it drove off the lot is worth 15% less, right?
if you
The
if you could
depreciation,
find the car, so
right? And then you got to go, yeah, you got to go, unfortunately, that thing has wheels, right? But there's clearly a healthy market. It's not like there's a problem getting auto financing, right? And so when you start looking at what are the other available investment classes, it would make sense that you could actually introduce greater levels of risk, or what we perceive as greater levels of risk here, because ultimately is it's just going to get benchmarked against other investment opportunities available in the market that day. Right. So it's actually still, so I think, and it's interesting, right? If there was a significant level of default or other issues, you would probably see that market push back and say, you know what, we're actually going to start and you see that from time to time as markets kind of progress is you'll say it's, well, actually, we're no longer at 75% ARV, we're really at 70% or et cetera. They'll change the parameters and the guidelines because the markets appear to be riskier or they're receiving higher levels of loan defaults in their portfolio. So they are actively changing the moves. And the most active movement, which you just said earlier, was 2022. So 2022 was not a credit risk problem, right? We weren't writing too aggressive of loans or those sorts of things. The problem, if you think about loan securitizations, is you are in the market as that market exists that day. So what are the offering rates? What are treasuries being? What can you buy a 10-year treasury for that day? What can you buy a pool of auto loans for that day? There's all sorts of benchmarks that they've got to compare against. And the biggest one, obviously, is what's considered the safest investment in the United States? Well, it's a 10-year treasury, right? And what was happening in 2022, right? It was the
To the
rapid
moon, baby. To the
to the
moon.
moon, right? It was 100% escalation in a period of 3 months, right? And so if you were holding on to loans and we were able to price those loans at the securitization level, so let's just say it's the blended cost of capital. So if we were going to, Brad's able to go and write a loan for 10%, or let's back, in a pre-2022 world, you're probably able to offer at 9%, maybe even sometimes even at 8%. It was a very competitive for these short-term loans, particularly in markets like California, right? And the reason why we were able to be so competitive is when you sold that loan to the aggregator, right? Well, they'd say, it's like, look, I'm actually only looking for about a 6% return on that investment. So if I can get, if you're able to get 8, that extra 2%, that belongs to you, right? I
Slicing
really
it
only
up,
need
baby.
6.
Yeah.
Because when they go to securitization at that $300 million level, well, hey, we're happy at 5, right? So if I can get my 1 point when I sit between those levels, right? But what happens when, and that's fine, right? Because what's your alternative? It was a 3% treasury. Well, what happens when your treasuries jump to 5%,
Yeah.
right?
And
Well, suddenly all of those markers just got moved, and they don't move. They moved massively and very quickly. And so now if you're holding loans at 8%, that's super problematic when you're trying to sell those loans now.
and DSCR, right before they started running away, we we used to offer the DSCR product, and
Yeah.
I'm not going to name any companies, but there was a time, and I was like, this is not going to be here forever. We did a deal in Florissant, Missouri, at 3.75%. That was January of 2022. You could
Yeah.
not even sniff that rate at your local credit union,
That's right.
bank, anything. I was like, this is mispriced. I feel like it's mispriced.
Sure.
But when you're packaging these up as bonds, it's like, how do they? We have 30-year, fixed. We're setting all right. We have maybe a prepayment penalty, a 5, 4, 3, 2, 1 step down. That's another component that I think that allows some of this money to be offered at the rate it's being offered at, because they're kind of
That's right.
insulating some of that.
That's right.
But then they sell these off for premium. So selling a bond, you either sell it for a premium, so you have par, which would be 1 or 100, and they'll sell it for a premium, call it 102 or 103. So you're actually, I don't like using the term double dipping, but if you charge 2 points origination on the front end and then you sell it off at 103, you're getting a 5 point rip on that. Oversimplifying it, but it's a very fascinating model on that. But when interest rates ran away, leverage cuts both ways. So if
That's right.
you're a loan aggregator buying these loans that were originated at 3.75, 5.5, you bought those on your revolving line. You maybe paid a slight premium for it because you're going to sell it off. This shit got priced overnight. So what they were able to sell for 103, it was a steep discount like in the 80s. Like they were like, we'll buy it at 82 cents on the dollar. So you saw these loan aggregators
Yeah.
real quick, and it happened fast. And then again, Wall Street, some of the sharpest minds in in the world, and they're smart. You work with them directly,
That's right.
some of these institutional lenders, and it probably got to a point after all of them are out and they took some hits and they figured it out. They're like, as of right now, maybe we don't necessarily need the aggregator in the middle. I don't know too many aggregators that actually returned. So they're all about efficiencies and arbitrage, and I think that is the one
Yeah.
thing that fascinates me the most. And I am your traditional trust deed and model or route, as old school as it comes, but I still like to understand how that works because there's something to be learned from the efficiencies that they have and their processes that they have,
Yeah.
and it's fun. I think it's
Well,
crazy.
it's interesting, right? I mean, because you said a bunch of things there that I actually want to push you on because I want you to elaborate further because I
Okay,
know this audience well enough that as you know, because you're very smart and you love to learn about these things and you
I
spend a
fooled
good.
you at least in this 30-minute discussion. I'm just kidding.
But so you like, what is a DSCR loan? What does that even mean? Like, give it to I tell ChatGPT to explain to a private lender who's never made one what is a DSCR loan?
So it is that stands for debt service coverage ratio. And that's basically just a heat check that you're going to have on leverage that they use. So they'll take, so when they first, let's backpedal to 2018 when these first started coming out. I remember the first DSCR loan we did was like 6.99%. This is when everything, I was like, this is insane. We just did a 30-year loan in the high sixes. And then on those first one, it was an asset-based private lending approach underwrite as well, where they literally took the leases, tied it into the bank statement. It's like, okay, those are there, income's verified. We
Mm-hmm.
have an appraisal. There's not even an updated heat check on market rents at that point in time.
Yeah,
You had principal, interest, taxes, and insurance. If there's an HOA, throw that in there. And they just wanted it to cover whatever threshold they had. And a lot of times they keep leverage at like 60, 65% anyways, because values in California are so much higher than any other states, and the income you get, the ratio is kind of skewed there. So it heat checks leverage. And we closed it like in 20 days. I was like,
yeah,
this is crazy. And the credit was not a real big hurdle on the credit. And then there was no prepay. That was another thing, no prepay.
interesting.
And then they started cranking out the volume, and they're like, then you started adding now it's more like, I would equate it now to almost as a full doc underwrite you'll get except tax returns going
That's right.
through like a non-cum. So it's like the no tax return is like the one thing that you're not going to get or have to put up. But I think it's a fascinating product for the investor,
Yeah,
and I think it's also a fascinating product if you carry a broker's license in the state of California to be able to broker. But based on what you said, licensing wise, you could tap into that capital and go into other states and go that route. So it can allow you. And at that point in time, it was getting super competitive in California. So we had some borrowers that were going out of state. So we were able to utilize that debt for out of state. Now, we are not a direct lender in that situation anymore, even though whatever other people want to try and say they are, we're not. So it's like we're brokering it, which is fine. And the borrowers don't care. It's like if you're going to hit the terms that you quote and hit the timeline, it, they don't care. But it's
that's right.
like,
That's right.
yeah. Anyways, I went down a rabbit hole there, but
But also, what's interesting about this, and I think it's a corollary that I think there's a few times in my career where I think people missed the mark. The first one was in 2013 to 2015. I think people missed the mark that being in one state and being in one region and just having a really small business is probably not a great idea. And I think a lot of people missed the mark that it was becoming a national model, and you could really scale your business much more dramatically if you were willing to get out of your comfort zone a little bit. And those that did ended up doing incredibly well for themselves, particularly because it reminded me of almost getting like a Fannie Mae or Freddie Mac based system injected or bolted onto ours, because yeah, sure, Brad clearly doesn't want to hold some property, some loan in Missouri because Brad doesn't live in Missouri, can't asset manage it, can't monitor it, right? So it would make sense. But now you've got a buyer or this liquidity party that says, look, I don't really care. In fact, it's better because I can't hold all these California transactions. I've got concentration risk problems. I want to see some Missouri thrown in there. I want to see these other states because I want to have a diversified portfolio when it comes time to securitize these transactions. So when I saw people just say dismiss going outside of California, particularly when I would go to the California Mortgage Association conferences, I saw a huge, well, I don't do that. And it always seemed to me to be a disservice, at least to not explore it further, right? If you
Yeah.
come to the same conclusion after you do it, okay.
But also on that, I think there's also different challenges in crossing state lines, which
Oh,
technology has changed greatly. So back in 2013, 14, 15, I would say probably over 90% of your traditional asset-based lenders in California, maybe not that high, but a high majority of them probably self-service their loans
that's right.
because you're able to self-service for your investors with a
Yep.
broker's license. And crossing state lines changes that,
Sure.
nuances state to state. Now, with outsourcing loan servicing then is far different than it is now because you could have the same controls in place, and now the outsourced loan servicing company you're using is an extension of your team to where you could hit those different states on that side. That was a challenge, I think. And then also loan documents. 2014 was far before Lightning Docs. I know Lightning Docs probably started, it was an idea. I would assume it was
There's
being
a
discussed.
twinkle in our eye in
Right, like
2015.
here, what
That's
to your
right.
point, like we see an opportunity going across state lines.
Right.
Biggest challenges: servicing, loan docs. You have to go
Yep.
find an attorney local to that state, and you're gonna price yourself out of the market paying per set an
That's right.
attorney. So there's challenges there, but I do agree with you. A missed opportunity. I feel it for some it might be stubbornness, but I think for others it's lack of ability to potentially do that
Totally.
with resources at their fingertips. But it's you know, I was going to ask you something. I'm not going to ask that question.
Was it the second? Was it the hidden second question that you had written in invisible ink? Go on.
uh, no, it was more so along the lines. One challenge I think, I mean, we have in leveraging some of the other capital that's out there. It's I give up control over that review process and that final underwrite. And then if you give up loan servicing rights, you're risking your borrower, giving up your borrower. So I think it's having a good team and trust in place with that capital provider that, hey, maybe they don't have a retail branch backdooring in online to get in front of your clients. Because the one thing we will see when deals get tight or scarce and margins get compressed, it's a dog eat dog world out there, and
Completely.
you have to close deals. So you got to keep that into consideration, I think, on who you're aligning
Yes.
yourself with.
And we saw that a lot. If you ever see Kevin, my partner Kevin Kim, and I speak, we always have the same message and have had for many years, which is you should keep your core business. You always should. And if you have, and particularly as you should have your own controlled capital. You will find yourself in devastation if you're relying on third party capital that you have no control over in the long term because markets compress quickly. But similarly, is that you should not ignore what exists outside of your bubble because they will have an effect. Because once we kind of talked about it a second ago, is if you were offering rates at 9% and 8%, et cetera, in 2021, right? Well, the only reason we were able to do that is because the cost of capital became much lower outside of the marketplace, right? So it's actually, if you could very easily find yourself in a situation where you are going to be priced far outside. And now you've got a bigger problem because now the only deals you're going to be able to get are deals you don't really want, right? And
Yeah,
so now you're taking on a real excessive risk because the secondary markets are so efficient at taking the better loans in place because they're pricing them so much more competitively than you. So it really is you don't have to use all these tools and you don't have to use the secondary markets and you don't have to do DSCR loans and you don't have to be national. You don't have to do those things. But you cannot ignore all those things unless you want to have a very, very small business. I think that's the way I've seen it.
yeah, and you also need to. So I spend a lot of time knowing what my competitors do,
Yeah.
what they price. I mean, everyone posts stuff everywhere, and then, but more importantly, they're their their procedures on how they get things through? Is there
Yes,
there's a cost on you're going to pay potentially on closing timeline for a 7.5 or 8.5
that's right.
9% rate on the high leverage thing. They're going to have their additional checks and balances.
That's right.
So it's a value proposition. You need to close in 7 days. You're not getting 85% loan to
That's
cost.
right.
You
That's right.
have 21 days. It's a business for me. It's a business for my investors, and it's a business for you, Mr. Borrower. So you should entertain that. And
Yeah,
same thing with lenders. It's like how can I potentially keep some of these borrowers happy
that's right.
in house and
That's right.
retain them? And it's understanding the tools that are available for you out there in the marketplace, and it moves quick. And sometimes like their price, get tighter. Then it's like, oh, we got to get a lot of money out, so it widens, and but it's just figuring out what you're good at and pressing on it.
That's
But
right.
it moves quick. Question for you: when you went to law school, did you know you wanted to be in the lending industry and practice law,
No,
hyper
when I went to
focus on
law
that?
school, I needed a job. That was my primary concern. I
Steve
went through
said the
this
same thing.
amazing time period from 2007 to 2010, which, as you know, was a great time for our country and for the market. So
And
I
for
had
graduates, yeah,
yeah, that's right. So I had the fortune of having my offer at a large law firm rescinded in 2010. And proceeded to cry my brains out over it because I had worked really hard. The great financial crisis occurred while I was in school. And so I studied my brains out and was very, very afraid of graduating into that market, rightfully so. And so I worked in the private lending space my first summer when I was in law school, so all the way back in 2007, 2008. And that's when I got my first taste of private lending. It was really odd to me at the time. And I'm like, oh, this kind of seems like a scam. Like, you got to remember, I was like a student loan borrower at the time, right? And I was like, I was also taking out loans at 12%, but I thought those were a scam. And I was like, oh, you guys have like this real estate loan and they're paying 12%? Like, who are we scamming?
and it's been around forever. Yeah,
And then but the loans were paying off, and it was like interesting. But Ponzi schemes take a while to really foment.
yeah.
So
And
I'm
there's some
thinking,
going on right now. We've seen a couple pop
that's
up.
right, right.
Yeah.
And so
Anyways.
I was very perplexed, and it really wasn't until, gosh, I was probably like 3 or 4 years into practice where I go, oh, like there's this thing called cost of capital, and you have to, if you're going to buy real estate, right? Do you take $300,000 of your own cash and save that amount of money and try to buy a property, right? Do you go out to try to get some friends and family to help, offset and get some equity in the property, and then go to a Brad of this world or someone else to get? So I started understanding that, hey, like most properties are financed, and they're financed through debt and equity. So if you actually look at what we do, it's actually very inexpensive in the broader context of how does real estate get financed today. And so suddenly the light picked up, but it was an accident, right? I mean, if the great financial crisis didn't occur, I'd probably be a securities attorney at a large law firm. That's what I was supposed to be.
And you always from California, or where are you from originally?
Yeah, I grew up out here in Orange County. I went to UCI for undergrad. I took, I think, 6.5 years to do that because great student, but that also meant that I had lived in a really tight little bubble from when I was born. So I lived in kind of a 25-mile radius and up to the age of 25. And so I really wanted to leave for law school. And I really wanted to go because as a very mature 25-year-old, I was like, oh, I should go to like a football school. And I also did and I was a terrible football fan because I was like, oh, I was like they got an awesome football program, right? Yeah. Great time to be there in the '07 to 2010 years with they literally almost got knocked out of ever being able to play football again during their booster scandal. And I went to the last game at the Orange Bowl where they got their asses kicked 42-0 by the University of Virginia. And I was like, hey, what am I doing out here?
This is not what I saw on ESPN 10 years ago.
100%. I saw 30 for 30. What's going on? So I went to University of Miami, and which is great. I met my wife there. That's really helpful. You should meet your wife in law school. My wife Natalie is amazing. She is my rock, and it's very helpful to be married to a lawyer as well, because she gets it. Like,
And,
this
and
job is very unpredictable. Um,
so it sounds like you married up as Corey and I did. That's what we like to say.
oh my god! Like, I mean, she's a better. It's just interesting, right? I've learned this the long. So I am now next year will be my 15th year being married, and it's really fascinating because you probably have a similar story for yourself, which is that I think, and I'm scared because I have a 7 and 9 year old, and I know you've got young kids as well. I actually think this may be the most important decision that people make, and it's really interesting, right? Because it's the one as a parent you have the least impact on,
Yeah.
right? You're going to work your butt off for 18 years to really like. I know you're a great dad. I see it all the time, and I talk to you about being a father, and it's crazy because I try to be one. Like I really love my kids. They're amazing. But like, holy cow, like that marital decision, like, because it'll go in either direction. Like,
Yeah.
you married a great wife. She's probably built you up. Natalie has been the greatest support of my entire life. She's built me up. But holy cow, like, I know a lot of people that have really, and particularly people that were great to then find them kind of just find a spouse that really takes them down or takes them down, narcissistic roads or otherwise. And you see people that you really love and go, oh man, like that person who I thought was amazing went in the exact opposite direction as well. So love's a hell of a drug.
No, it's spot on, and it's we can't we can't put in the hours or do what we want to do on the business professional side of things without the support at home. And then
Totally.
also, just in raising the kids, you can't do it by yourself. I mean, you could try, but
Yeah.
it's tough, and it's nice to have. Um, Nice is not the proper word to use, but it's extremely fortunate to have Jerica at home to kind of I say battle these boys together because at the end of the day, it's just we got to be together and do everything we do is for the kids, and it's I don't
Can
know.
I ask you a question? Because this is the same question whenever I'm on any podcast, and
Beep,
I'm
beep.
I'm talking to a young father. Did you imagine your life being this way? Meaning that did you imagine that you would have the career that you had and be able to have the family that you have and the relationships you have with your children?
So I always hoped that I would have a family and
Yeah,
kids.
yeah,
If you asked me when I was in college
yeah,
that I would be running my own company for 8 years now and in the
yeah,
private lending space,
yeah,
I'd say, what is private lending?
yeah,
And two, I'm not an entrepreneur. Hell no,
yeah,
I won't be running my own company.
yeah, yeah,
But it's to your point how certain things happen for a reason,
yeah,
and it's you cannot close any door or burn any bridges throughout your entire career, and you're
right.
establishing this network when you're in school, actually in high school, when you're in, especially in college, and then any company you work at, you don't know where you're going to be at in 5 or 10 years,
Yeah,
and it's just I think about that actually a lot, and it's
yeah.
interesting to see how where we're at now in 2025, and it's yeah, there's I did not think I would be doing this,
And
but
it's
I was
interesting
hoping I'd have kids.
And it's interesting too is if you take that one level further too of being within private lending, is I never really appreciated how small and insulated this industry is and how people tend to stay within it, but tend to move around a lot within it as well.
Yeah,
And so it's fascinating to me just of so much of our own story here at the firm and within Lightning Docs has actually just been kind of watching people's careers within an industry, and it's a wild place. I had no idea. I'm like actually, it's weird to be thankful, I guess, for a great financial crisis that ruined what you thought was going to be your dream job. But like, I actually couldn't imagine. I'm really happy I didn't end up there. I really prefer. I love this little place, and I really enjoy that you can be kind of part of something that seems unique and meaningful. That most people still, as you know, I'm sure most people you talk to are like, "What do you do?"
we do loans for real estate investors. Yeah, that's it.
Right?
I want to pivot a little bit. I want to jump into Lightning Docs.
Yeah.
When was Lightning Docs
When did we go from a
first?
twinkle?
Yeah, from a twinkle to where like, hey, we are
Yeah.
going all in on this, and I want you to share some of the challenges you guys had in
Yeah.
doing it because you don't scale to the volume you guys are doing now.
Yeah.
One overnight, and two without any challenges.
It's a testament to a lot of amazing timing and a lot of luck and a lot of things completely outside of our control. So Lightning Docs was a complete accident. We needed an efficiency tool as a law firm. We were writing loan documents. I needed to be able to do that at scale for different clients who had different needs. And so it was born out of absolute necessity. There was no current tools available that we could find. We were using mail merge and those sorts of programs prior to really focusing on automation. But that doesn't work when you need to write unique conditions, right? So if I'm writing a loan for Brad and Brad really likes this part of his note, he wants to have a 10-day grace period, but Jimmy over here, he wants to have a 15-day grace period. All these little nuances, it's really difficult to manage those. But now take that and add, we're making loans in Florida and then we're making loans in Colorado. Oh, we'll now add another component. One of the properties is commercial real estate. One of the properties is a single family, right? So it was born out of complete necessity. We needed a tool and we needed to take all the things we were learning as a law firm, which are what were the licensing rules in Colorado and Florida? What were the things that we needed to know to be able to institutionalize those within the loan documents so that we could write repeatable rules? So basically, you kind of just think it's like the dump of things I've learned in my brain had to be written in code, basically, to be able to just write loan documents as a practicing lawyer. And that's all that Lightning Docs started as and was intended to be. And it wasn't until 2018 when DSCR started coming around, one of our largest customer of Lightning Docs, and was our very first customer of Lightning Docs, would come to us and they try to close 30 loans in one day. And we weren't built for that as a law firm, right? And it wasn't, we'll give you 30 loans every single day. It was, hey, at the end of the month,
we're slammed. We got to close. Right.
And so there was no, I couldn't build a model around that. And they knew that we had built a software tool and said, hey, like, we can handle the title stuff. We can handle all the other stuff that you guys normally do as a law firm. I don't need you for that. I just need to sleep at night knowing I've got loan documents that are going to work in Florida and Missouri and everywhere else. I know that you guys have built I know that the documents are consistent. Whatever you guys are doing, it's working, right? So that started. That was 2018, and I was terrified, right? I was a lawyer. I did not want to be in the software business. I had no intent or plan to do that.
And as a lawyer, you're probably thinking about exposure and what if something.
Yeah, and also too is like I don't like you. Obviously, software is a lot less expensive than a law firm is, right? So I didn't want to hurt the law firm business while we're just growing a software business, and so we were very quiet about it, and that's why you probably never heard about it until years later, because we didn't have a separate company, we never talked about it. It was like we don't, that's right, and it wasn't until 2021. And it was making about half as much as the law firm practice was doing the same thing. And I go, oh, crud. This thing is not a hobby anymore.
Well, you factor in the scale that you're able to apply to it, to where the staff you would need to do that, even if you're charging more. Right. The manpower behind it is not feasible.
That's right. And we quickly learned and pivoted at that time, saying, and that was a real change, right? And also mental thought process about it, because I was worried about it all the way up even until 2021 is I was always law firm first, right? This thing was a law firm tool. It had to do everything the law firm needed. And I wasn't really thoughtful about what makes for good software at the time, right? Like you're not worried about user experience and user interface. The terminology, who cares? You're like, I just need good docs, right? And in the software world, we call it product. I knew that it had to be great product. I didn't really care about how that product got put together. But that's not how software works, especially modern software, right? I didn't worry about integrations and APIs and all that stuff was like, whatever, that's an afterthought. Can it produce quality documents that don't get you sued for malpractice, right? So, but post 2021, it was like, well, hey, we need to put a dedicated team of people on here. We need to make sure that we're actually building, and we need to understand technology a little bit more. And so, that's been for me, my greatest personal challenge is being a lawyer and not having a software background and trying to understand enough to make very big software related decisions about what kind of underlying software are we going to rely upon? How well does it integrate? How do we think about ourselves in a modern world with e-closings and e-recordings and all, really thinking about the software challenges ahead of us rather than the loan document challenges ahead of us. And so that's been the challenge. But the growth story has really been one of, I think, the fact that we were a private lending law firm that was hyper specialized in the space. I think people knew that they could trust what we were producing on that side. And if it was the same thing that the law firm was going to use, I think it gave a lot of credibility on the software side. So while we have many more competitors now than we did previously, I think that the nature of where we sit today is in a really privileged position. I think I said earlier, and there's, more than half of the top 50 national private lenders in the country are using it currently. And so it's really an honor, but it's also the thing that keeps me up at night, right? Is if I make an error, if we mess something up in this thing, Brad, like we put out 5,200 loans last month, right?
Yeah.
Like that error is going to be everywhere. Like there's so much perfectionism that you really have to master in what we're doing.
No, absolutely, especially how quickly, especially in California, legislation changes or new bills that come down and little. I don't like using the word tweaking docs, but
Sure,
you need to make sure it's pulling through. But I would also add that lenders out there, they need to have the ability to review the docs. I'm not
that's right.
saying the nuances of the law, they're putting reliance on you guys for that,
Yep.
but ticking and tying, you still want to make sure everything's pulling. We are putting reliance on it, but ticking and tying is what I like to say.
Yep.
Um, so it's no, it's been fun to see, and I think having everything so readily available, it's about efficiencies, right? It's
That's
all
right.
right. If I had to email my attorney and get those docs within 24 to 48 hours, maybe 3 days, depending on workload, end of the month. If I'm on a 7 day closing timeline, that doesn't really work for me, or a 10 day. Can I have someone on my team draw
Yeah.
these docs
Yeah.
and we review it? And I think it's remarkable on how that has played
You hit
out.
the nail on the head, Brad, which is that, that's the lesson I learned in 2021 was I was really worried about cannibalizing the law firm business, but I learned a few things along the way, which is that, because it's not just, and you just hit the nail on the head. It's not always a cost. Cost is important, but generally, if you're, especially in California, these loan sizes are fairly large, right? And at the law firm, we were always really efficient. So we weren't charging that much anyways on a per transaction basis, right? But the problem you really run into oftentimes, or particularly when people are scaling and scaling heavily, is that it was the time, right? Because you, Brad, can go online at 9 o'clock tonight and clickety clack and get loan documents. But you can't yell at me, the lawyer, and say, hey, I need you to work at 9 o'clock tonight and I need them by 9:30. I've got to review them because I've got a borrower coming in at 8 o'clock in the morning. And
Yeah.
so what it really empowered, I think, people to change was it gave them the control of closing that I think is oftentimes the larger decision-making part of it.
Confidence in process. You need to have your
Absolutely.
confidence in your process, and you have that, then you could confidently price out deals and get a
That's
little
right.
bit more firm and navigate those waters. Two more questions for you because we're pushing an hour here. I told you to go quick. Uh, Lightning Docs and Fortra nationwide. You have clients nationwide. Um, DSCR has clearly been a big component, game changer for lenders over the last since pretty much 2018, 2019. Right now, we've been, or at least the last year and a half, been seeing a lot of ground up construction deals
Sure.
being offered. Do you see any pockets in the United States that are drawing maybe area of concern for you guys just based on what your clients are telling you on what they're seeing? Deals taking too long to get completed or softening. Now I have a 75, what I thought was a 75% ARV loan, which I think is high, 75% ARV loan. Once it's completed, we've had a softening 10% pullback in the market. Now we're sitting at like 85,
Yep.
90 bars getting stretched. Any pockets in the States that you're seeing that?
We're not really seeing those types of issues, right? I mean, I think that there's a few different things that I see. So one is that California continues to be an incredibly resilient market, but it is a very diversified market. So if you're going to lend in San Diego versus LA County versus Orange County versus San Francisco, they're very, very different markets. And there's lots of very disparate rate changes. So if you're like, for example, in Northern California, like you're a full 100 basis points less than you are in Southern California. Like it's just a very different ballgame to play. So you really do need to understand the locality of the market. But I see that more in the national landscape. So, for example, Florida, there's a lot of fear of rising insurance rates and uninsurable properties. And I'm sure California has its own mix of that, right? We obviously have the Palisade fires, right? So these issues loom, right? But I ultimately is actually what I see that's probably more impressive than all that is that despite all of these headwinds, the average user on Lightning Docs is continuing to grow their volumes year over year fairly substantially, in which I think is a much harder climate this year than it was last year, right? So it really does show you that that you can have a lot of these challenges presented and still do really well.
Yeah, it's gonna be interesting to see how it plays out. And this is not a doomsday call or market crash call, but I do think in California specifically, you hit a few different markets there, right? Within those counties, you have different pockets and regions there where some are greatly underperforming, and you're seeing pullbacks.
Yeah,
Days on market are increasing. We have inventory increasing, and depending on the leverage that these borrowers are taking out,
that's right.
they only have so much bandwidth to have that cash burn. So if their days on market goes from 30 to normal, like pre-COVID, you'd expect 45 days to 60 days to market your property, and then another 45 days for it to sell in a lot of markets. The 14-day, 7-day, 14-day offer. So it's going to be interesting there to see how those navigate. And I think that values are holding, but you just need really 5 to 10%, be off by 5 to
That's right.
10% on some properties, or a trade
That's right.
flat to where you could kind of be in a tight spot. Again, it'll not a doomsday call. It's just when
Yeah.
times are good. And we've seen it in COVID and in 2022, how quickly markets change.
Well, and it's interesting, Bradwin, because my entire legal career has been marked by home price appreciation, right? All the way back to 2010, right? But the thing right before that 2010 thing didn't. And so we haven't actually had yet in this 15-year run of any real chinks in home price appreciation. And I think for the first time, we'll see. You're in a state like California. I think we're probably one of the more insulated ones, at least in most of the coastal markets, right? But we'll see. We'll see where the next few years head for us, and if whether that changes that dynamic.
One last question for you, and pencils down. Bucket list trip for you and your family. Money is not a concern. You go anywhere in the world. Where's Mr. Nema taking the family? What are you guys doing?
It's not so much a trip, but an experience. I really want to live in a mountain town for a season, and I want to get the kids. I tell the kids all the time, I want to get we'll homeschool or whatever it's going to look like, and I want to go skiing every single afternoon with the kids, and just let that be one season of our life. I don't know whether it's going to happen or not, but it's where my heart is.
And give me the chills. That would be fun and an experience, and
That's what I want.
it's like you're working on the sundial. The sundial is your clock during
Right.
the season. So, well, Nema, it's been over an hour. I really appreciate
Thank you,
all
Brad.
that you do for the industry, us, your participation, support of CMA over the years. It's been unwavering. So thank you for that, and really thank you for coming on this unscripted interview, conversation, non-podcast. So thank you for that.
Brad, this has been one of my favorite podcasts. I appreciate your time and all that you're doing for CMA over there. You take care, bud.
All right, Neil.